Very good evening, learners. Warm greetings to one and all who are joined here in this webinar, and our sincere thanks to the guest speaker for this day, who's joining us from um, Texas, USA. So even in spite of the early morning there, he is joined us in order to enlighten our learners. So, on behalf of the Directorate of Online Education, SRM University, Chennai, we extend a very warm welcome to Mr. Hemant Manda. I now invite Ms. Sri Mahalashmi to take over the session.
Yeah. Hi, good evening, one and all. I'm Siri Mahalakshmi, and I shall be anchoring for this virtual event. Respected Honorable Guest Speaker, Mr. Hemant Manda, sir, Director of Online Education, Dr. Manoranjan, sir, Program Coordinator, Dr. M.L. Jnanadashan, sir, all the faculty members, and my dear friends. Thank you all for joining this live virtual session on the topic Incubation of Technology Startups, which basically involves providing support and resources to help new companies grow and so by the end of the session, all the learners will get to understand how incubator enhance the chances of startup success, reduce failure rates, and accelerate growth. So with that said, it's my privilege to introduce our esteemed guest speaker for today's session, Mr. Hemant Manda sir, who has over 20 years of experience in the technology and enterprise software industry. And he is also specialized specifically in the area of data and AI. Now I request Mr. Adrian to give introduction of our today's guest. Adrian?
Ladies and gentlemen, esteemed viewers, and my fellow students of SRM. It is with great pleasure that we extend a warm welcome to today's distinguished guest, Mr. Hemant Manda. As the founder and CEO of Infogis LLC, a startup making its mark by building and scaling groundbreaking business applications, Mr. Hemant brings not only cutting-edge innovation, but also a deep, heartfelt commitment to nurturing the future of technology. Before founding Infogis, Mr. Hemant had a remarkable journey with IBM, where he served as the executive director for the data and AI organization. In this role, he led a talented team of over 20 product and partnership executives, overseeing key relationships with tech giants AWS and Microsoft Azure, and driving over 250 million in annual revenue. His leadership was instrumental in launching the revolutionary IBM Cloud Park for Data platform, a milestone that streamlined and modernized IBM's data and AI portfolio. But for Mr. Hemant, this wasn't just about products and profit. It was about creating solutions that empower people and businesses to thrive in a rapidly changing world. His career has been defined by building relationships and driving positive change. As Chief of Staff to Rob Thomas, General Manager of IBM Data and AI, Mr. Hemant played a pivotal role in shaping IBM's M&A strategy. He led IBM's business development team, working on acquisitions, divestitures, and strategic partnerships. Through his efforts, he not only managed complex deals, but also ensured that every move was thoughtful, strategic, and forward looking, always aiming for long term value creation. Educated with a BTech from IIT Kharagpur, followed by an MBA from University of Texas at Austin, Mr. Hemant has over 20 years of experience in the tech and software industry. His story is one of continuous learning, evolving from managing large scale operations to stepping into the world of entrepreneurship with Infigos LLC, where he's building something truly special. With his broad experience in both strategy and execution, Mr. Hemant's leadership continues to inspire. But beyond his professional success, what makes Mr. Hemant truly stand out is his humanity. A devoted family man, he balances the demands of being a tech leader with the joy he finds in his family life, whether it's running or playing basketball on the weekends or spending quality time with his wife and two children in Dallas. Mr. Hemant embodies a grounded and loving approach to life. I could go on for another page or two, but without taking any more time, I would like to say that today we are incredibly fortunate to have Mr. Hemant here to share his insights on a topic that is at the core of his passion, the incubation of technology startups. With his deep understanding of both corporate leadership and startup innovation, we are in for an enlightening and inspiring session. Please join me in extending a warm welcome to Mr. Hemant Manda, a visionary, a leader, and a man whose journey continues to inspire us all.
Yeah. Thank you, Adrian. So before I invite our guest speaker, I request all the participants to not ask any questions during the talk. We'll have a separate Q&A session at the end where you can clarify all your doubts. Now, let's warmly welcome Mr. Hemant Manda, sir, to share his valuable insights.
Welcome, sir.
Yeah, thanks, Dr. Gyanadeshan and Mahalakshmi and Adrian for the warm introduction. And I would like to extend my thanks to SRM College for giving me this opportunity to speak. I've basically put together a few slides based on my experience, and also I've taken some content from presentations I've heard. The intent here is twofold. One is basically talk about uh, how you can go about creating your own startup organically. Also, I'm going to share some thoughts on if you want to either acquire an existing startup or build a partnership, the inorganic means of actually embarking on a startup journey. So looking at it from both the perspectives, right? So when you're looking at a startup, I mean, startup journey, in my opinion, is very rewarding, but at the same time, it is very challenging because when you're thinking about doing something of your own, right, you have to own everything. You have to create things from scratch, and I think there are a lot of ups and downs, and you should be willing to take up the challenge, and the results are very rewarding because whatever you create, that is because of your hard work, and it is very fulfilling from a overall satisfaction perspective. So the way you need to look at a startup, in my opinion, is essentially answering four questions, right? Looking at how do you address these four questions. The first and the foremost is what business problem you're trying to solve. What is the market opportunity? Is there a pain point from a customer perspective? Whatever you build, is it something that people are willing to actually consume and pay for it? And unless it's a significant pain point, building something is not advisable, because if it's not solving a problem, right, an existing problem for customers, then it won't be successful, right? So it's extremely critical before you embark on a startup journey to ask the question why, right? Why is this useful to customers? Why would they be willing to pay for it? And is this something that is going to be relevant in the long term, right? It might be a problem today, but is it going to continue to be a problem down the road? So thinking about it from a market perspective, looking at the competition, looking at how much opportunity is available, looking at how that problem statement will evolve, will grow, is extremely critical. If you don't do the diligence, I'm sure, like as part of your MBA course, you might have looked at all the different factors, but it's critical to spend some time on it, make sure that whatever journey you're embarking is something that is relevant from a business perspective, right? So that's the number one thing. The number two is essentially around what product or service you will be building to address that problem, because any problem statement will have multiple solutions. There are multiple ways to attack it. So you need to think about building something that where you can bring your strengths to the table. And there needs to be some unique value proposition in the product that you're bringing to the table. So thinking about that journey of what is that you are contributing is also extremely critical, and there are multiple facets to it that I think we can go at length. The third is the team. In my opinion, team and culture are also very critical to the success of a company. So as you're embarking your journey, you should think about what your initial team is, whether you're going to have a co-founder or co-founders, or is it going to be a solo journey? Who's going to be your initial set of team members? How you plan to scale it? So you have to be thinking about it on a regular basis, and it's extremely critical because, in my opinion, a success of any company, not just a startup, ultimately boils down to the employees, the team that you're building. And if you don't have the right people who are aligned to the vision and objective and mission of your startup and company, it's very hard to succeed. So why, what, who, and the last is how, right? because startup journey obviously entails resources. You need funding. And in my opinion, funding can come from two different sources. Either you raise money from investors to initially kickstart your journey, or you essentially create a product which is very attractive to customers so that customers are willing to pay for it right away. So you're funding it through the revenue is generated from customers. Usually, when you think about startups, people usually gravitate towards raising money from VCs and trying to basically fund the initial investments through raising money from investors. But there's also an alternative way, which is use your own money. We call it bootstrapping, to start something and then create a product that is valuable to customers so that you can actually start generating revenue very quickly and use that cash flow that you generate to further invest into your startup and grow, right? The advantage of doing the secondary approach is that you own pretty much everything. Whenever you take money from investors, obviously you're giving them a stake, you're diluting your value in the company. However, by making sure that you're using the revenue from customers to invest in it, you own everything. So there are pros and cons to both. I'm just suggesting there are two different ways to do it. Or you can raise money, but don't raise a whole lot of money from investors. By driving revenue faster, you can have a more significant stake than you would if you were to dilute your investment. So in addition to these 4 questions, you also need to think about your business model, how you're going to price it, whether it's going to be a subscription-based business or it's going to be a standalone software. You need to think about the technology, infrastructure, and tools that you would be using. Of late, there's a lot of value in terms of embracing artificial intelligence and Gen AI to automate some of the things, right? You need to have a strategy around that. You also need to think about processes, right? Whether it is processes from an operations perspective, processes from a go-to-market perspective. So all these things you obviously have to think through. But again, to me, the 4 important questions you should try to answer is, why is this relevant? What is the product or service I'm going to build or take to market? Who is my team? And then how am I going to fund this, right? So I believe that these 4 questions are extremely critical to answer before you start your journey. And then finally, I also need to think about what value you're bringing to the table. What are some of your unique strengths that you actually can contribute, and what is the value that the team is bringing to the table? So, I mean, we can spend a lot of time going through all these different issues. I'm going to focus more on number 4, how are you going to essentially think about cash flow, think about funding, think about customers. I'll also touch some of the other aspects, but I think the primary focus today would be on number 4. And if you have questions related to the other pieces, we can cover in the Q&A. The reason being, usually 1, 2, and 3 are covered in MBA courses. 4 is something that you typically don't get. So I would spend a little bit more time on number 4. So when you think about a typical startup cash flow profile, right? Initially, you are cash flow negative, as in the revenues you're getting are lower than the expenses that you're incurring. So somebody needs to fund that negative cash flow for the first, let's say, 2 or 3 years. And after that 2-3 years, you start actually generating positive revenue, right? So you would have some positive cash flow left that you can use to essentially invest into your own businesses. And I think this cycle is slightly different from products versus services. Typically in a product or a platform company, the amount of time it would take to essentially generate positive cash flow is much higher than a services company, because in services, the expenses are very proportional to the revenue. It might take a few months or maybe a year to essentially turn cash flow positive in a services company. That's why people tend to gravitate more towards services. It's a low risk. Whereas in a product or a platform company, there is quite a bit of investment that needs to go in before you actually start seeing revenues. However, on the same note, the revenue multiples for a product or a platform company is much higher. So the reward is also higher. So it's, in my opinion, product or a platform company is high risk, high reward, whereas a services company is a low risk, low reward. So as you're thinking about doing a startup, the very first thing you need to answer is what type of a profile you're comfortable with. You want to go with low risk, low reward, in which case a services company is more appropriate for you. However, if you would like to build a product and you're willing to take the upfront risk of investing and seeing the revenues and seeing the fruits down the road, then you should probably go with the product and a platform company. Also, the other thing, as I mentioned earlier, right, even in a product company, the amount of time, right, and the amount of cash that you would need to manage your negative cash flow, you can reduce that by getting paying customers earlier. So if you can accelerate the process of getting customers earlier, you can reduce the negative cash flow cycle, both in terms of the amount of time it's going to take and also the magnitude of that negative cash flow. So that's why I think figuring out how to get paying customers, making sure your product is very valuable at the get-go, I think it's very critical and important because it's going to solve your funding challenges. It's much easier to raise money, and even if you don't raise money, if you have positive cash flow, you can use that to essentially invest into your company and grow it. Also, I think just to share how typical valuations are these days, I'm going to take the example of a SaaS company. In the early stage, typically valuations are based on revenue multiples because in the early, like first 2-3 years, you don't have profits. So there's no way one can value a company through multiples of profit or EBITDA. That is not relevant. So what typically people do is they use a multiple of revenue, and on the later stage, when you're profitable, when you have positive cash flows, then valuations are based on a multiple of your profit. And then typically what we see is in the early stage, you're looking at multiples of around 5x to 10x. And there are a lot of factors that determine how this is valued. It depends on the team you have. It depends on the growth rate that you currently experience. Obviously, the higher the growth rate, the higher the multiple. But a typical range we see for SaaS is around 5x to 10x and during the early stages. And in the later stages, it's based on multiples of profit, and typically you're looking at 10x of your EBITDA earnings before income taxes, depreciation, and amortization for a product company. For a services company, that range is usually around 7x to 8x. Services company, the multiples are slightly lower. Given that, I mean, sustaining the profits is a little bit more challenging with services, whereas in product, sustenance is much higher. So this is what we've seen in the market. If you're looking to actually raise money, I think this is something that you can use to value a startup, right? And if you're just getting started, then it would be based on projected revenue, right? Because then you can project your revenue 1 year or 2 years out and discount it a little bit and raise your money accordingly. So so I'm going to walk through a simple example here of how these valuations and raising money from VCs work, right, in a real life situation. Think about a scenario here where I think you're raising money, right? This is initially in year 1, it's bootstrapped, you're putting your own money into it. Year 2, you're raising a seed round from either VCs or friends and family or angel investors. And year 4, you're raising Series A. Year 6, you're raising Series B. And I think as you're raising more money, as you're raising more capital, typically what happens is your share of ownership decreases. So on when you raise seed money, you have 80% ownership. You gave 20% to the investors. And Series A, from 80%, it decreases to 60%. And Series B, it decreases to 40%. So by Series B, your share is actually less than the share of the investors, which is perfectly fine because you're taking that money, you're investing in your company, and you're growing the company, your revenue is going up. So even though your share has decreased, overall valuation of the company has increased, right? So overall, there's a benefit to you, there's a benefit to the investors. And let's say, for simplicity's sake, year one, year two, you had zero revenue because it's a product company, you're trying to build a product, you're building an MVP, you're looking at product market fit, trying to get the initial customers, do a beta testing of the product, etc. So year one and two, there are no revenue, right? You're trying to figure this out. By year four, you have 2 million, and year six, you have 6 million. So when you look at valuation, using the multiples, right? You're essentially looking at approximately, assuming 7x multiple. By year four, you have 14 million, and year six, you have 35 million. And I think your share is essentially 8.4 million in year four and 14 million in year six. So if you take the same example and see like less reliance on VC, like if you let's say if you focus accelerated revenue growth, instead of 2 million revenue in year four, if you can make it 3 million, and instead of 5 million in year six, if you can make it 7 million, if you run the same numbers, you can see actually both the founder as well as the investors would benefit. So you're creating more value if you can focus on having faster revenue turnaround. So that the point that I would like to make through this example is raising money through VCs is important, but even more important is creating value by driving more revenue. And I've seen this with investors and as well as with entrepreneurs. There's a lot more focus on raising money, raising capital, raising VC funding, and building the product, and not a whole lot of focus on in terms of driving revenue and driving sales and driving marketing. So if there's one thing that you want to take away from this presentation, is that when you're thinking about a startup, the most important focus need to be on the customer and in terms of how do you add value to the customer and how do you drive more revenue, right? Faster revenue and more revenue right upfront, right? If you can cut down the revenue generation cycle time, you would significantly benefit from that, right? Your value, and it can be clearly seen from the valuation numbers here. It would be beneficial for you, it would be beneficial for the investors, and it's easy to raise money. So as I mentioned earlier, right, in a startup, typically when you're looking at funding, the green line is illustrating the capital raised. You initially would raise money, and then after a certain period of time, that plateaus. You are not raising money anymore. Revenue usually is linear. So revenue, as long as you're managing your growth rate, revenue linearly grows for a period of time. There is a specific time point when the amount of revenue you're generating equals the capital raised right at that point. Ideally, what you should try to do is, and you call this revenue break-even point, you should try to get to revenue break-even point as soon as possible, right? You should try to reduce the amount of time it takes to get to that break-even point, and that actually helps drive value both for you and for your investors. And typically, what we've seen is companies that can achieve ARR, which is annual recurring revenue. This is specifically for SaaS. Think of this as annual revenue. So companies that achieve annual revenue greater than invested capital in 2 to 3 years tend to have successful exits, right? And this is the trend we've seen across the board. So your objective should always be, how can I accelerate my revenue and make sure that I'm actually generating more revenue than the capital that I've raised in the first 2 to 3 years, right? That should be your objective when you're starting a company. And I think you should always remember that revenue is what actually drives valuation and success. not the amount of capital raised. And we've seen this with multiple examples. There are companies who have raised like hundreds of millions of dollars, but it does not matter much if you're not generating revenue, if your growth rates are not decent, and if you're not profitable after a certain period of time, right? So it's very critical to keep these fundamental things in mind as you're thinking about a startup, because that would help essentially dictate your strategy, right? What do you need to focus on? Focusing on the customer, focusing on the product experience, and making sure that you're adding value are extremely critical than managing your investors. Because if you can drive more revenue and growth, investors will automatically come to you. And I think, as I said, more paying customer makes the whole process of raising money, VC due diligence, a lot easier, right? Because you have it. I mean, the fact that customers are paying for your product speaks for itself. And the customer-funded growth model and also ensures, right, a tighter feedback loop. I mean, I'm going to go through this in a couple of slides from now. Actually, what I mean by this is, if you have paying customers, it actually will get you more customers, because those customers ultimately will become referenceable. They will talk about your product. So there are network effects that actually are going to drive more customers and more revenue for you. So it becomes essentially a self-fulfilling prophecy. So I think the things, again, that I would like to reiterate, right, is you should think about having a clear value proposition, right, from a product perspective. In my opinion, that is extremely critical. What is the value you're bringing to the table? What business problem you're solving, and how you're uniquely differentiated compared to competition. So you need to be very crisp and clear on this to be successful. Second is you need to understand your customer very well, right? Because again, I think not everyone is a fit for your product or service. So if you're going after B2B enterprises or small, medium businesses, and even that, if these customers are in a specific industry vertical, so you need to have a very clear understanding of who your ideal customer is, and also who you're selling to, which is ideal buyer. So having this understanding upfront is very critical. If you don't have a good understanding of your ideal customer profile, then it becomes a challenge to basically market and sell. If you're going after everyone, then it is very hard to scale and be sustainable in the long run. So I would say, I think this number 2 is also extremely critical. And then once you know what your value proposition is and who your ideal customer is, then you can start focusing on building a sales and marketing engine. Initially, it would be more marketing related, and then slowly you start building your sales engine in terms of how do you basically drive customer adoption and revenue. And then, as I said, right, number 4 is once you have initial set of customers, and as long as you're delighting them, as long as they're seeing value from your products, that essentially becomes a referral engine, and I think they would advocate your product, which will in turn bring you more customers. So your delighted customers, think of them as your salespeople, right? Your free salespeople. So that's something also extremely critical. So again, I think these 4 steps, right? Having a clear value proposition, identifying who exactly your customer is, building an effective sales and marketing engine, and then delighting your customers so that they advocate for your product. This will essentially ensure that you are driving faster revenue, and I think you're scaling quickly. So there is another concept that I want to talk about, which basically connects to my first slide. As you're thinking about a product or a service that you're bringing to the table, right? I would say, and as you're thinking about basically messaging this to your customers, there are 4 things you need to keep in mind. The first and foremost is what is the pain point that your product or service is solving, and then trying to basically have a claim against that pain point. You need to have a direct connection between your product and service and to the customer pain point. Second is perception, right? When a customer has a pain point, he or she thinks about that pain point with a specific perception. So your messaging, like the way you're basically messaging a product and service, need to address that specific perception, so that it is a compelling story, a compelling connection between what you're talking about your product and the perception of the pain that a customer is experiencing. Three is when a customer is willing to purchase, right? The transaction process should be very frictionless. It has to be very seamless. If it involves a lot of steps and if they need to go and reach out to a customer service or a salesperson, and if there's paperwork involved, the more laborious the transaction experience is, the lesser your adoption rate would be, the lesser your revenue would be. So it's critical to ensure that the transaction process is as seamless as possible. Hopefully, it's just a click of a button. So if you can minimize the amount of time the customer is actually spending on essentially purchasing your product, the better off you would be, right? Especially in terms of scaling, because if you want to scale it to hundreds of thousands of customers, you want to make it as seamless as possible. And the last and final thing is delighting the customer. The way you drive this delight is essentially by making sure your product experience is perfect. What are you building, or the service experience? So you should always focus on like trying to get some feedback from customers and making sure what are some challenges in the product. Like focus on the design and ensure that at the end of the day, the experience that the customer is going through is basically perfect, which essentially would allow them to advocate for your product and be a referenceable customer that drives more customers and revenue for you. So these are the four different axes that I would essentially think about. Think about how do you build the product, and also how do you message it and scale it. And of these, I mean, again, I think if you essentially try to put this on a chart, right? I would say, again, I think there are different levels here. For example, your customer might have a pain point, but unless that pain is significant, people are not willing to pay for it, right? So I think you also need to make sure that whatever you're building, whatever problem statement you're going after, has a significant pain point that can drive value. So let me quickly. I have a couple more slides, and it looks like I'm almost coming to the 40-minute mark here. So I want to be mindful of leaving some time for Q&A here. And then in a sales and marketing funnel, right? For us, I mean, I'm going to take the example of a SaaS product here. Some of these stages are valid for a services company as well, or any product and service that you have. But it's good to think about the sales and marketing as a funnel. The first step in this funnel is awareness, right? People need to be aware that there is a product like this exists, that there is a pain and there's a solution. So unless people are aware, you won't even get them interested or consider looking at your product, right? So first is building awareness, and this can be done in a number of ways. It can be done by promoting your product on websites, etc. And once people know that there's such a product exists and it can solve these problems, then you want to make them interested in your specific product, because for a given pain point, there are multiple solutions. There's competitors out there. So the second is to ensure that you compare and contrast what you're offering with that of your competitors, make the customers interested your product and consider your product. And once that happens, then I think comes the trial. People want to either do a POC, or if it is available for a free trial, they want to essentially play with it, see the value that they're getting out of it. And I think once a customer is happy and satisfied with the trial, they want to move to the purchase process. That's typically people just stop here, right? I mean, I think if you think about most companies, all they're interested in is selling my product, getting revenue. But this is only half. It's not even half the funnel. you also need to think about how do you basically onboard the product, onboard the customer onto the product. How do you drive adoption so that the customer is using your product significantly and driving value from the product. And I think in a subscription case, you should also think about how do I drive renewal, right? Renewal. If you want to get repeat business from that customer, so you want to decrease the churn rates, and you need to increase the renewal rates so that that customer is actually a paying customer for a longer period of time. And then I think about expanding it. You can think about cross sell and upsell opportunities, or driving more more consumption. And then finally, advocacy, which is more around referenceability, right? So all of these different stages are extremely critical, in my opinion. People tend to just focus on sales being just selling the product, which is number 4, which is, in my opinion, is the wrong way of thinking. You should be looking at all these different stages, and if you can increase value in each of these stages, then you would be a lot more successful. Ultimately, that's obviously going to drive revenue and dollars to you. The first 2 to 3 stages, it's more marketing and lead generation. And I think the latest stage is essentially sales, in my opinion. So you have new sales, you have renewals, and you have expansion. There are different ways to essentially drive more revenue, right? So they're all sales, but they're different types of sales. And you might need different type of people to drive it. And also, when you're thinking about a startup, right, and trying to think about how do I drive customers and revenue, in the initial stages, the founders need to be the sellers. There are a couple of reasons for this. One is, I think you'd be a lot more effective, right, in terms of positioning your product and solution, because you've been thinking about the strategy, you've been thinking about the problem, business problem, the customer problem, and why this is relevant for your customers. So you're passionate about it, you know, you're a subject matter expert, having spent a lot of time on it. So you can do a much more effective job during the initial stages. Also, usually what happens is when you're selling your product, what the messaging that you're using, you need to iterate that for the first few customers. So it's critical to be engaged upfront in the process so that you can learn, you can see what is resonating and what is not resonating, and take that feedback and essentially fine-tune your messaging during the initial stage. So I would strongly recommend the founders to be heavily involved with the sales, at least one of the founders, in case you have co-founders, just to make sure that you're getting that messaging and sales pitch right. Because once you have it right, then scaling it by hiring specific salespeople is a lot easier. Second is, I would say, like, even before you build a sales engine, you should think about how do I build a lead generation or a marketing engine. And there are different channels for this. I mean, you can think of webinars, trade shows, right? Google SEO, right? Or SEO could be on, again, multiple digital channels, Meta, Instagram, right? There are, again, depending on what type of product you're bringing to the table, there are multiple ways to essentially drive lead generation. And then I think you can have specific metrics to track how effective these marketing initiatives are, right? So you need to first think about how do I optimize the marketing engine, and then think about how do you build the sales team. And again, I think here the points to keep in mind is whoever you hire for sales should align with the ideal customer profile. For example, if your product's ideal customer is, let's say, an enterprise, then your salesperson should be experienced in large enterprises, selling to large enterprises, and ideally have connections with large enterprises. Or let's say you're targeting small and medium customers in retail, then obviously your salesperson should have experience in that specific space. And then I think once you hire relevant people, then you need to focus on having a process and a training system and having metrics to track the progress, etc. So I think so far I think I covered on how to you go about driving success in an organic startup. But there's also another way to look at startups, especially off late. You will find a lot of marketplaces where you can buy existing companies, and these companies range anywhere from few $1,000s in revenue or $0 in revenue to let's say $1 million+ in revenue, right? So you have very small companies to fairly successful companies available on our marketplaces. I've listed a few marketplaces here, and you can, as long as you have funding, you can go and acquire them and try to scale them. The advantage here is you don't need to go through the hard journey of building something from scratch, getting initial set of customers, getting reviews and referenceability. Here you can focus on essentially taking something that is already built with existing customers and existing revenue and drive scale to it, right? So this is a different way of looking at startups. And some of the considerations, right? If you want to take this route as opposed to building something from scratch, some of the considerations you need to keep in mind is what type of synergies you bring to the table, right? There needs to be some value you're adding that existing founder cannot. Maybe you're more technically competent. Maybe you're good on marketing and sales, or maybe you have another product with you right now. When you buy this new product, there is some incremental synergies between the two products, so that 1 + 1 is not 2, 1 + 1 becomes 11, right? Also need to think about optionality. The product might be addressing a specific need, but maybe you see another need which will drive a lot more value. So thinking about it from that perspective is very helpful, because usually when somebody sells something, they're selling it at fair value. So you need to think about how can I add incremental value to it, either because of your strengths or because of the optionality it brings to the table. The second thing you need to think about is if the product is mature, how much support workload is involved. Does it really solve a valid customer pain point? Is that pain point sustainable, right, with the trends? You need to think about these things, because it's critical that whatever you acquire is sustainable and can grow over a period of time. Obviously, you need to look at revenue, right? And there are multiple metrics from a revenue perspective: trailing 12 months revenue, monthly recurring revenue, annual recurring revenue, growth rates. So, and as I said before, typically your valuation is a function of revenue and growth rate. So I think these metrics are critical. Also in a SaaS business, some of the other metrics that you should focus on are churn rate, right? How quickly customers are churning. And if it has trials, what is the conversion rate? If 100 people are trying out your product, how many of those 100 are converting? A higher trial conversion is better for you, because then as long as you can get more people to try out your product, a higher conversion will essentially lead to more customers, more paying customers, and more revenue. And then finally, I think lifetime value. This is also critical, because if you have low churn rate, then I think you likely will have a high lifetime value. But if you multiply the lifetime value with number of customers, you can approximately get the value of existing install base or existing customer base. Another point to look at is expenses, right? Because just because it's got good revenue doesn't mean that it is a good business decision to buy it. Like, the expenses obviously need to be manageable, and at the end of the day, you want to drive profits from anything that you're doing. So looking at the expenses and looking at overall profit is also very critical. And typically, when you're looking at expenses, you should exclude any founder expenses, right? And just look at what incremental expenses would be for infrastructure and for employees, etc. Right? So that's what you typically look into. And then the couple of other factors that I would also focus on are competition. Because by looking at competition, you would say, first of all, how attractive the market is. More competition is not necessarily a bad thing, in my opinion. Having competition is sometimes good because that essentially validates that this is a good problem set that other customers are experiencing, and there are people who are interested in providing a solution. But it's good to compare and contrast the product you want to acquire with that of competition so that you get a good sense of whether how unique it is and how does your product compare to that of competition, etc. You can also get a gauge of how your competition is doing, how big the competitive products and companies are. So that also gets you an understanding of the potential scalability of whatever you're acquiring. Also looking at brand recognition, reviews, customer references of that particular product or service is critical. That will tell you the advocacy piece. Remember the funnel, the very last one is advocacy. So this is essentially going to tell you the referenceability and the advocacy of the product. And I think, and finally, these days you have products that are built on ecosystems. When I say ecosystems, I'm talking about platforms that have marketplaces such as Salesforce, Zendesk, Amazon Marketplace, Atlassian, etc. Sometimes buying a product that is related to an ecosystem is desirable because associating yourself with an ecosystem essentially means that lead gen is a lot easier because getting net new customers, you're going to drive these customers from the ecosystem, right, from the mothership. So that has its pros and cons. Pro is that obviously you drive more traffic and easy lead gen. The con is that you're tightly associated with the platform. So I think that constrains you on how much you can grow and how fast you can grow. So something to also think about. And finally, if you're taking this route of acquiring something, you need to remember that price is only a small part of the negotiation. You also need to think about a lot of other terms, such as transition support, like whether the seller is willing to do seller financing, how do you structure the deal, how much do you pay upfront versus how much you distribute later, the whole payout schedule, where the legal jurisdiction is. For example, if you're based in India, you're buying it from a seller in US, right? If there's a dispute, which court jurisdiction will it fall in, right? Indemnification, if there are some issues from the court, if, for example, down the road somebody sues you that the code that you bought has been copied, right? To make sure that you have some clauses around it, some protection around it. And also think about whether you want to acquire the asset or the whole entity, as in the whole company. So some of these other things you also need to think through as if you're looking at acquisition. So that's all I have. Let me just quickly summarize what I went through. I think the first and foremost thing, and I shared this earlier, focusing on paying customers and as quickly as possible, right? Avoiding any delays actually will help you to be successful in a startup, both in terms of raising money and also in terms of driving more valuation and having a successful exit, right? So if you think about starting your own company, I think the number one thing you should focus on, how do I get to paying customers as soon as possible and scale that, right? Second is, I sincerely believe that all founders, right, at least one of the founders, should be involved in selling during the initial 1, 2, 3 years, right? Because that way you can actually get real-time feedback on what is working, what is not working in terms of sales, and that would allow you to essentially fine-tune your messaging and appropriately scale. Third is investing and building the lead gen side of the equation, the marketing engine. First is more critical than the sales, right? So that way you're essentially driving traffic before you thinking about selling and driving renewals and expansion, etc. So I think if you're thinking about investing in marketing and sales, I think I would focus first on lead gen, which is the marketing engine, and then the sales engine. And And then I think the other thing also to think through is that when you're building a sales, when you're hiring sales, ensuring that you have an effective process in place, both in terms of training, onboarding, as well as specific metrics to track their progress is critical. Otherwise, what happens is you essentially hire a sales team, but without the process, without the metrics, without the onboarding support, you're essentially spending a lot of money and resources without any success. So just hiring people is not good enough. You need to have an effective process to go hand in hand with them. And last but not the least, be open to alternatives, right? There are multiple ways to doing your own startup. You can build something from scratch, you can acquire, or you can build something and then partner with someone. So there are multiple ways to think about doing something of your own. There's no one size fits all. So that's all I have. Hopefully this is helpful for you guys. I'm open to answer any questions you might have.
Yeah. Thank you, sir, for sharing valuable insights and time with us. Now the session is open for queries. You can unmute yourself or feel free to share your comments and questions in the chat.
So can you share some insights on how to get funding from government schemes or something like that in India? I have a small startup. I'm using all my savings. I haven't acquired any investors or any loan or anything. But since the business is growing, I need more funding, and I wish to know more about if there is any government scheme I can use.
So, I mean, I personally don't have insight into how to get funding from Indian agencies in US. The way it works in US is it depends on the product, right? If the product has some public benefit, if it is more related to an innovation, or if it is related to potential use in the defense sector, in US, you can actually go apply to this funding resources. The application usually takes a few months, so it's not like raising money from a VC where if they're interested, they're gonna right away write a check to you. So there's some bureaucratic process that happens, and this is in US. I frankly don't have direct experience with getting funding from government agencies in India. So I can try to check into it, and then I can try to get you some details. But yeah, I at this point I don't have experience as to how to go about it. If you don't mind sharing, what is your product? I mean, what exactly is it doing?
Sir, I am manufacturing and selling perfumes. They are Indian based.
Got it. Okay. And then your customers are based in India?
Yes, most of them are based in Arabic countries and India.
In India, okay. Again, I think the different agencies, right? Like whether state governments and central governments, they try to promote entrepreneurs and they have different policies. So best is to essentially it's easy to do this research online. So best is to basically look out and do some research on what agencies are promoting entrepreneurs and what is their consideration and criteria, and if you want to apply for grants, etc. Right? I think that's what I can think of. I'm sorry, I can't be of much help because I don't have specific knowledge on the Indian agencies.
No problem, sir. It's absolutely okay. I just have one more question. I just need an opinion that I am doing my marketing by myself. It is going very well. I did everything on my own. I did not hire anybody. We are a team of 3 people right now. Do you think I should give my marketing to an agency, or should I hire an individual as a social media manager or something like that? What would be more beneficial?
Uh, so so agency versus an individual is the question. Okay. Um, I mean, again, I think it depends on a few factors, in my opinion. If you can find a good agency, and if you can structure the agreement in such a way that what you're paying the agency is essentially um, a portion of your sales, right? If you can structure it in that way, then agency, in my opinion, is good. right? That way, let's say if you are getting additional $100 or you give them $10, right? 10% or whatever that percentage is. So if you can structure it that way, I think I would say agency is good. Otherwise, given that you're just three people, I would focus on hiring someone and making sure that that person is actually contributing and increasing your sales. And if that doesn't work out, you can always hire someone else, right? It gives you a little bit more flexibility and freedom. So that would be my opinion.
All right, sir. Thank you so much. And it was a great session.
Yeah, thank you.
Yeah.
I see some, yeah, sorry, go ahead.
Yes, sir. There was a question from Ashik that how to get investors for a startup.
So I think getting investors from a start, I mean, there are multiple ways to go about it, right? Obviously, off late, you can actually go on some forums like AngelList is one. I'm sure there are a lot of forums where you can participate and socialize your startup idea. You can also go and do some networking, right? You can go and directly apply to VCs. You can talk to angel investors. So there are multiple sources of socializing and driving awareness of your startup. And I'm sure if you talk to, let's say, 30, 40 people, similar to the sales pipeline, there'll be one or two who would be interested, right? And then would be willing to invest in it. So that's one. Second is you can also go to your friends and families, right? Initially, you don't even need to go to a VC or an angel investor. If you have a good idea, you can essentially socialize this with your friends and family and then ask them to invest initial pre-seed round. And having that investment would help you essentially build an MVP, have some initial customers. Once you have the MVP and an initial set of customers, going to angel investors is better because that way you're not just going to them with an idea, you're going to them with something more tangible. So it's easier to raise money from them, right? So again, there's no right or wrong answer here. There are multiple ways of doing this.
Yeah. So another question which is relevant to the above answer is, which is a better solution among VC and angel investor for a startup with 5 crore?
So usually 5 crores is I'm just trying to think. It's less than $1 million, right? So 5 crores is the revenue or is the valuation?
Yeah, it's revenue.
Oh, it's revenue. Okay. So I mean, again, I think I would say it depends on a few other factors, right? Whether what type of product this is. This is a technology product. What type of business model? This is subscription based or like pure software or pure services. What is the growth rate, right? So depending on that, right? I mean, ideally, I would tend to think, assuming this is technology, this is growing very fast. I would say seed. I think it would be ready for seed A, the Series A. But if not, I think probably it's more of a seed stage. Also, like where it fits in, it also depends on time. Because if you had asked me this question in 2020 or 2021, where people were investing left, right, and center, I would say like even with no revenue, people were raising Series A, right? But these days, it's a little more challenging, right? You need to have a proven product, MVP, minimum viable product is in place, market fit is there, right? Before you can actually go and seek Series A. So some of these things are very subjective and depends on the time and depends on some of the factors that I mentioned.
Since we are running out of time, now I request Shamima Parveen to deliver vote of thanks.
Thank you, Sri Mahalakshmi. Mr. Hemant Manda, our program coordinator, Dr. Yamal Jnanadasan, greeted you with good morning, while us, the students and the staff, have planned to eat dinner and retire to bed right after this session. This session that has crossed the time zones is proof that the recent innovations in technology, where holding meetings in real time has become the norm. I hope you played very good basketball this weekend because I was reminded of Trey Wallace's quote. I was on an automatic pilot. Ideas for gadgets kept on coming, fed by force of energy flowing through me and around me because that is the energy that you brought to the session today. The session was about incubation of tech startups. And I was wondering whether it was going to be about the tech startup plans in India, like 10,000 startups, incubate scheme, startup India scheme, or the prime venture partners. But you started with a very basic question of how to build a startup. And you started with the 4 basic questions of why, what, who, and how. What is the business proposition? What is the problem that you're solving? And what is the product or service that you're offering? And who are your teams or resources? And how are you going to fund? While these same questions seemed a little bit intimidating, you also reassured that every problem has multiple solutions and multiple ways of attacking it. You also gave us the example of funding problem that for example, going through VCs, there are options like using boot camps where we can use our own money and our own savings for our own startups or buying other startups. You iterated the importance of business mode, infrastructure, and processes. While some of us here who wants to run a business or want to become overnight millionaires by just playing a Surya Vamsam song or Annamalai song in the background, you iterated that having a typical cash flow initially has a negative cash flow for any business, and after a few years only, that is a positive cash flow which can be used to reinvest in the business. This you even explained with the examples of product or platform type of company and the services type of company. You said that the product or platform services company are slower to pick up, which is high risk and high reward, which can be managed by getting customers who pay early with a lower credit period, while the services are quicker to get more positive cash flow, which is a low risk and low reward. And I think that is the traditional form of businesses that majority of the people prefer. You also explained a detailed illustration with various numbers and examples with detailed calculation, where you said that the key takeaway of that illustration was having less VC will result in more share for the founders. And the second key takeaway of that illustration was creating value drives more revenue for the product. And the third key takeaway for that was cutting down revenue generation cycle time will be greatly beneficial for the startups. You also went on to explain about capital efficient growth plan, in where you explained about the revenue break-even point that should be reduced and the average revenue which should be greater than the capital invested, which will lead to a high ROI. And you also went on to explain that revenue growth drives valuation, but not the capital raised. And the third point is more paying customer makes VC due diligence problem easier. And the fourth is customer funded growth model will multiply your customer base, which is a self-fulfilling prophecy that can be done by your business. You explained the 4 universal axes of alignment, which is the pain point or the product comforts, the compelling story, the frictionless transaction, and the insane delight. Thinking of these 4 axes, I got reminded of Ivan Wall's statement, which says that knowledge is power, but enthusiasm pulls the switch. And I feel that the incubation is the lever that activates the switch. And you went on to explain about sales and marketing funnel, which starts with awareness, goes to interest and trial and purchase and onboarding customers and adoption and renewal and expansion and advocacy. For people like me who thought this starting a business is going to pour in millions of money, you explained that marketing not only stops there, it goes to acquiring new and renewal customers, and it goes to expansion, which really expands our business knowledge. You also explained a bit more about sales and the marketing engine. In the beginning, the founders must sell marketing engine for lead sales generation, and building a sales team who align with the ideal customer profile are very, very important for any startup. Since finding jobs is difficult these days, I thought of starting a startup of my own. And I was quite intimidated by the detail and the depth of your session, the knowledge that you shared in the session. But then I realized that there is another way of acquiring a startup, which is acquiring a startup, not just starting one, but acquiring it. And through marketplaces, and you also gave a few leads for marketplaces, and I'm very happy about that. Right after this session, I'm going to reach out to my parents for acquiring a startup and fund it so that I can become the CEO of my own business even before I complete my MBA degree. I'm going to read more about the key considerations for acquiring the business startup so I may remain well informed. With this, I would like to extend my gratitude to our guest speaker, Mr. Hemant Manda from US, for sharing your thoughtful insights with us. I'd also like to thank Dr. Manoranjan Ponram, Director of Online Education, SRM IST, Management of SRM, for organizing this program. I'd also like to thank Dr. ML Jnanadasan, a Program Coordinator for MBA SRM IST. And last but not the least, all learners for their patient listening. Hope you all had a great learning. So I wish everyone a happy morning, a happy afternoon, happy evening, and a very good night to all the participants across this world, because diversity. Thank you, and over to you.
Thanks. That was a great summary. Thanks, everyone, for inviting me. And hopefully, I shared some insights that would be helpful to you. And if you need anything else, please don't hesitate to reach out.
Thank you. Thank you very much, sir, for your time and your preparation you've done in the PPTs and all that. You should have taken much time for this and efforts. Always welcome, and we thank you from the bottom of our heart. Thank you.
Yeah, thank you, Dr. Ganadhasan here.
Thank you. Thanks all the learners also. Okay, we may sign off. Thanks. We'll meet in the next webinar, which will happen sometimes in a couple of weeks. Thank you. Thank you, sir. Yeah.